Hope everyone had a great 4th of July. Thank you so much for joining us. We're going to do things a little bit differently this time. I know a lot of these names are very familiar to people that come on these relatively frequently. So today we are going to have a guest speaker. You can see Mark there, Mark Peterson from BlackRock. And this is a testament really to everyone on this call and, kind of being with us and sticking with us and helping us grow. We're starting to insource a lot of our investment choices over the last several months. Actually, we just started it. And to do that, we needed the right mix of not only people inside, but also technology that has just become available in the last couple of months at LPL, as well as some strategic partnerships. By far the most important one being with BlackRock. And again, why I say it's a testament to everyone that's on this Zoom is they weren't talking to us 3 years ago, right? So, and you know what? They shouldn't have, right? We were not amongst their target market. Now, being in the top 0.1% of advisors at the largest broker dealer in the country, now we are able to get strategic partnerships with people like BlackRock, who I think it's worth adding are the largest asset managers in the entire planet, right? So on Earth, they manage more money than anyone else. So it's great to be able to work with them and actually, quite frankly, be able to get them to do something like this, both as well as on these economic webinars, as well as helping us with an asset allocation, kind of moving forward. So it's going to be a little different today that I'm not going to be doing the talking. Mark is. I think we'll stick with answering questions at the end. So what we'll do is at the end, you can answer questions. Most people will hit, there's a raise your hand icon. You can hit raise your hand if you have a question at the end. Most people at that point unmute and turn on their video, for questions. Also, I have difficulty remembering the questions towards the end. Feel free to use the chat box. So if a question grabs you, in the first couple of minutes, especially, we plan on going maybe a half an hour of discussion. But if something grabs you in the first couple of minutes and you want to chat it in, and we'll make sure to go around at the end and catch back up with it. So with all that being said, let me introduce Mark. Mark is the director of Market Portfolio Insights team. He's been in the industry over 25 years. And what I love about Mark is he seems to be amazing at not just saying, here's the economic information, but what I've noticed that he's really good at is he says, here is the economic information, and here is how we at BlackRock are acting on this and investing accordingly. So he ties the two together really, really well. Mark went to Arizona State University, and he's worked at a couple of other really high-end places. He was on the floor at the Board of Trade at the Chicago Mercantile Exchange, which I think would be so fun to do. And he was actually he was the head of product strategy and economics at Deutsche Bank, which is a German bank that's one of the largest in Europe. So he's had some pretty big jobs, including this one. I think you will enjoy what he has to say. I will be here the whole time. So always, as always, you can ask me questions at the end, as well as Mark. He's happy to stick around and answer some of them for you. And with that, I'll turn it over to you, Mark.
Great. Thanks, Jason. Evening, everybody. Thanks for having me on your call today to talk a little bit about what's going on in the market and the economy. We'll do it through what we call our student of the market piece, something we send out to advisors on a monthly basis, and just trying to highlight some things that we're seeing in the market, seeing in the economy that hopefully helps really digest what's going on and where we think things are headed for the rest of 2024. If you just Google BlackRock Student of the Markets, you can find it out there. They tell me it's one of the most searched BlackRock pieces out there. Maybe it's me hitting the Google search button a bunch of times, but certainly something we're proud of. So you'll notice right away I'm a chart and graph person, so I didn't leave many in the bag tonight. So bear with me. We'll try to bring those charts and graphs to life as much as we can. We'll try to hit some highlights just on what we're seeing both in the markets and the economy. Obviously, no shortage of content, right? Just given everything we've got going. Also, the election year getting a lot of attention. We'll hit a couple election slides and also talk about where we think there's some opportunities here. So broadly, I think just looking at the big picture, we are leaning a little bit into risk right now. It's worked out pretty well for us here over the last year and a half, really since last November, when you look at it. And that's been a good thing. And really part of that is expecting the Federal Reserve to lower interest rates here at some point in the second half of the year, maybe once, maybe twice, but also seeing the economies on reasonable footing, certainly slowing, decelerating, but on reasonable footing where we don't expect a recession. That's a pretty good backdrop for riskier assets, especially on the stock side. We've seen that play out in a big way. So I think just overall backdrop, that's what we've seen. But getting into the slides here, just starting with what the markets have done, you can see U.S. stocks have led the way here, up 15% to begin the year. That's on top of being up 20+% last year. You can see smaller companies not doing as well. International trailing a bunch. Bonds pretty flat to start the year, and cash holding up pretty well in a higher interest rate world. So this is what we're dealing with. I think for the second half of the year, we don't think too much will change here. We do think large caps are well positioned to lead. International showing some signs of life, so that's hopeful. The bond side probably has a little bit more potential. We just have not seen bonds really rally at all on the backdrop that I started with. The expectation of lower, shorter term interest rates in the second half of the year should help bonds and fixed income. On the stock side, one of the big stories is the technology space. Just looking back historically, here's the best starts to calendar years for tech stocks. You can see that it was the fourth best start since 1990. So what is that, 35 years of history? The tech sector's up about 28%. S&P 500's up about 15%. And you can see there were a couple years here better to start the year. 2023, most recently 95, 98 during the tech bubble. And then probably most importantly, just look at the right side of the slide, the second half of the year, what those really hot starts to the year for technology stocks, how'd they finish? You can see some of these years like 1998 finished even better. But generally, it held up pretty well. The momentum continued in the second half of the year. Only 2 years we actually gave some of the return back. I thought that would have happened more, where you had such a good start to the year, where you're up well into the big double-digit numbers, yet you have very few periods where you gave it back. Only 2 periods where you lost money in the second half of the year, and only 3 times that you underperformed the S&P 500 in the second half of the year. So I thought that was interesting that off to a hot start with technology, certainly been a catalyst here the last couple years, really on the excitement around artificial intelligence for a lot of these names. But that momentum generally carries through. Not every time, but we do think this is a trend that's going to continue into the second half of the year. There certainly could be a pullback here. They've run hard and fast here over the last year and a half, so it wouldn't be unusual for them to maybe give a little bit back. We've seen signs of that here at different points in time, but broadly, we still think it's a trend to lean into. The other big thing that we're seeing in the market, and this doesn't get talked about as much, is that there's very little volatility in the stock market right now. And what we mean by volatility is just how much the market moves up or down in a given day. Just simply measuring it by number of 2% trading days in the marketplace. So any day the market's up 2% or down 2%, we check that off and count that. And look at the story over the last, 25 years of how this volatility story ebbs and flows, where it tends to be either all in, like periods like 2008 and the global financial crisis. You had 72 days where the market's up or down 2%. And it probably felt that way if you all recall back then. There's about 250 days the market's open in a year. So 72, that's one every 3 or 4 days you were getting a 2% move, if my Arizona State math is right there. But you can see the story with this volatility. It's either all in or all out. And lately it's been all out, where there's very little volatility, where we've had 2% day this year. We've had 2 last year, all of last year. So you got a year and a half of data, and we've only had 3 2% days. Contrast that with 2022, which was a very tough year. Only the third time in history that both stocks and bonds lost money in the same calendar year, going back about 100 years. So 1931, 1969, and 2022 were those 3 calendar years, and you had a lot more volatility. And look what happens when you get a lot of volatility in the marketplace. The stock returns are much more challenging, right? Basically flat. All bets are off here. But when you get 10 or fewer 2% trading days on the far right in the yellow bar, you average almost 18% in stocks. So, great example where the market really is comfortable with where we're at with the economy, what it means for profits and earnings and dividends. And that's when you see these periods of low volatility. Look at all these periods where you get high volatility. That's the market trying to digest where the markets, or excuse me, where the economy's headed. What's the impact going to be to earnings and profits and dividends on those stocks? And that's when you get a lot of those 2% days. When you get no volatility, it tends to be very good economic footing. Of course, more recently, 2022, it was all about inflation and the Fed having to raise rates. How much of that was going to take a bite out of the economy? That was the big question. But this is something good to keep an eye on. If you start seeing a lot of volatility, that probably means the market's concerned with where the economy's headed and what the impact is going to be to the bottom line of some of those companies and stocks. Another big story, I think with the markets, and we touched on it earlier, is larger companies have really dominated performance versus smaller companies. And it's really been something we've been living with the last handful of years. You can see here 2024 on the far left, the last 1 year. Look at the last 3 years, probably the most shocking, where smaller companies here in the US have actually lost money. Not huge, but lost a little bit, where larger stocks are actually up 10% per year over that time period. So I think a little bit surprising. And then on the right side is a 3 year rolling chart showing the 3 year difference between large and small. So when the red line's up top, large caps underperforming. When the red lines in the bottom, small caps are outperforming. You can see large caps have outperformed by about 12.6% here over the last 3 years. So it's a pretty big gap, the largest gap we've seen since December of 1999. But it has gotten a lot larger in the past. April of 1990, it was over 20%. And some of the thought here is that when you get a big technology leap forward or transformational technology like the internet back in the mid 90s or artificial intelligence today, is that these larger companies are just better positioned to really reap the benefits initially than smaller companies. It takes a while for smaller companies to figure out what's the best way to invest and really benefit from artificial intelligence, where larger companies are just better positioned to make those capital expenditures in the near term. So I think we're seeing that play out a little bit here lately, where large caps are just better positioned in this type of environment to make those advancements sooner than smaller companies. That's why we're seeing some of that outperformance. Also, smaller companies tend to be a little bit more sensitive to interest rates. So higher interest rates tend to be a little bit more of a drag, just because they haven't been able to really finance their debt and drag that out over a longer term time period like a lot of the larger companies. So those are some of the differences driving it. But we think this story is going to continue. And you might see something similar to what we saw in the late 90s, where you get a really big stretch of large company outperformance. I mentioned the economy looking at reasonably solid footing for the economy, but certainly decelerating. And I think you see that on the chart here. This is just economic growth up top. You can see what it looks like overall. Certainly decelerating, but staying well in the positive territory. At least that's the expectations here for the rest of 2024, even into 2025. Doesn't mean that there isn't risks to the economy slowing more dramatically than we expect. I think that's one of the more risks that are out there. But generally, the employment picture still looks pretty good. 4.1% unemployment rate. It's ticked up a bit. Certainly, the makeup of jobs isn't tremendous. You're seeing a lot of government, healthcare, A lot of leisure and hospitality jobs. That's really leading the way. You're not seeing it in manufacturing and some other areas. So that's a little bit concerning. But generally, it's still a solid unemployment outlook at this point in time. So we feel decent about it. It is decelerating. We do think it'll allow the Federal Reserve to lower interest rates here in the second half of the year, as we mentioned. And again, that's a pretty good backdrop when you get that combination of a good economy with lower interest rates. That bodes well for both stocks and bonds. And the inflation story certainly been a dominant economic feature for us here. Really going back to June of 2022, you had over 9% inflation back in June of 2022. We're down to right around 3.3% today. The hope is by next year, you get it down well below that 3% number. But it still means prices are up. Don't get me wrong. Prices are still higher than they were, but we are seeing inflation come down. Never comes down as quickly as you thought, but it is our reality. I do think we probably get below 3% at some point this year, which I think psychologically will feel better. Again, still means prices are higher, but this has been a big challenge for us. Clearly, it's why the Federal Reserve had to raise short-term interest rates from 0 to about 5.5% where they sit today. But we have made progress here. The numbers come down. It always tends to come down over a period of time here. Really, one of the sticky points right now is the fact that rents are a lot higher than we thought they'd be. Rents are an enormous piece of the inflation calculation, by the way. It's about 36% of the overall inflation number is just what you'd rent your house or apartment for. And those have been a little bit sticky. And we're seeing about 5.5% inflation there, but we are seeing rents start to come down. I'm sure there's some landlords on the call. If you rent a home or an apartment or condo, you know that it's tough to change rents quickly. So rents were trailing on the way back up when inflation got to that 9%. Now they're trailing on the way back down, but I think it'll be some comfort or at least some slack, which will allow inflation to come down below that 3% number. So certainly something that's driven the story here the last handful of years. But the picture's getting better, just slowly getting
Testing one,
better,
two, three.
just taking some time.
The expansion of NATO
So if we look at the a little bit more on inflation, why we're a little bit more optimistic in the second half of the year is second half of the year, inflation tends to be a little bit lighter,
that really
especially over the last 20
Putin's,
years. If you look at it,
kind of contain
second half of the
the
year,
NATO now
inflation's
has
lighter, whether you're adjusting for some seasonal factors or not. You can see what it looks like. Second half of the year, inflation tends to be much lighter, which tends to bode better for bond returns in the second half of the year. It's been a rough stretch for bonds, but look in the second half of the year, they're almost doing twice as much as what bonds did in the first half of the year, at least 50% better in the second half of the year over the last 20 years. So I think that sets up well for bonds in the second half of the year. As we mentioned, they really have not seen much of a rally. You had a big rally back in November and December in bonds, but you've given some of that back here to begin 2024. But we do think there's some potential there. And here's a little bit more detail on that theme that I started with that I keep poking at. Just the fact that when you get a Federal Reserve rate cut with no recession within 12 months, look at the returns on the left here for stocks and bonds historically. Right? So this is just a scenario where the Federal Reserve starts to lower short-term interest rates, but it doesn't coincide with a recession within the next 12 months. Look at these returns. 21% on stocks, 8% on bonds, even cash returns 6% in these environments. Granted, some of the interest rate periods here, rates were much higher, but you get the idea. This is why we're leaning into risk at this point of the cycle. We just think it's a pretty positive backdrop. We've seen the rally in stocks, I think. Really going back to last November is when this scenario really started to get priced in a big way. We just haven't seen it as much on the bond side. Where normally you see bonds return above cash in this environment, just doesn't happen so far here in 2024. On the right side, you can see, look at the difference here. if you get that Federal Reserve rate cut, but then it actually follows with a recession that coincides, look at what happens to stocks. And it's an enormous difference. Bonds do well in either environment, which is one reason why we like bonds. So bonds in the yellow look good. Cash rates start to come down in a big way in that environment. So that's why, again, fixed income, we think, has some potential here in the second half of the year. But again, we're leaning on this left side of the slide. This is why we're leaning into risk in our portfolios. We just think the backdrop is fundamentally positive going forward. I mentioned the election and had a couple slides just on the election to hopefully maybe calm some fears here. This is the last 10 years. If you just stayed invested in the market the entire 10-year period, so ending last year in 2013, so from 2003 to 2013, 100,000 grew to 311, which is not too shabby. But look what happens if you only invested when there was a Democrat or Republican in office. Your results almost the same, by the way, which is ironic. But look at the difference between just staying invested the whole time. This is why you want to keep politics out of your portfolio. I know we're all polarized. It's always very dramatic. But the last thing you want to do is something drastic with your portfolio, like taking out of the market. We can drag this out over a longer term time period, like 70 years. $1,000 grew to about $1.5 million if you invested back in 1953 when Eisenhower was in office. Grows to almost 1.6 million. But look at the difference. Again, if you only invest when your preferred party is in office, enormous impact on the outcome. I've actually had people check my numbers here. They're like, no way that could be that big of a difference. But it is when you start interrupting the power of compounding investment stock market returns over time. It has an enormous impact on your outcome. That's what you're seeing on the right side of the slide. And normally election years are pretty good for markets, generally speaking. You can see normally stocks do around 10%. Election years slightly better. Midterm election years like 2022, that's when markets do a little bit less. And odd years tend to be the best, like last year, up 26%. That certainly added to the 14.8%. But the last one I'll leave you with on the election that I think is important is just looking at the various sectors or parts of the stock market and the economy and how they performed under different administrations. So a lot of different colors and numbers here, but focus on the middle. Look at the Trump and Obama years here. And you can think about, we all know how different those administrations were, both stylistically and policy-wise. But look at what was the best performing parts of the stock market. They were almost identical. It was technology, it was consumer discretionary, it was healthcare, and the worst performer for both was energy. So even though these administrations couldn't be more different, what was actually the best and worst performers in the stock market were very similar, almost the same between those two administrations. I think really speaks to where we started this election section, which is keep your politics out of your portfolio. The market tends to have its own story. The economy has its own narrative and momentum to it. And some of the short-term politics certainly can influence things, but generally the market narrative will carry the day. So the fact that we're in the cycle where we're going to lower short-term interest rates and we don't think we're going to get that recession bodes well for both stocks and bonds and risk assets. So I think this is always a good one to remind ourselves, no matter how polarized we are politically, right? It didn't matter between Obama and Trump. What worked and what didn't work in the market in those years was pretty darn similar. Last one I'll finish up with here is just a commercial for diversified portfolio. Something that we always lean into is just reminding ourselves why we build portfolios the way we do. This is a chart that looks at a diversified 60-40 portfolio. It's not exactly optimized for the perfect allocation right now. So 60% stocks, 40% bonds. Of course, everybody have a little bit something different based on your investing risk tolerance and where you're at in an investing life cycle. But I think it tells a great story. Look at 2008. very tough year, global financial crisis. Even in a diversified portfolio, you still lost 28%. That never feels good. And I tried to capture the emotions there with my fancy emojis. I think the extent of the BlackRock visual library. Then on the other side, when the market goes up again, the bull market returns, you're up 237%. But look at how much you trailed the US stock market by. It was huge, enormous gap between the two. That doesn't always feel good either, where you don't make as much. And look at the last couple years. This has been the story. Lost 24% in the first quarter of 2020. Look at coming out of the pandemic and the shutdown, how much you trailed in that diversified portfolio. Then you lost money in 2022. Then you didn't make as much money last year, and certainly this year as well. This is why a diversified portfolio doesn't always feel good emotionally, because you just never get that satisfactory feeling, or that where that you can plant the stake in the ground and claim victory. So it's emotionally challenging, I think, to own this diversified portfolio when you march through these various cycles and difficult time periods. But of course, the punchline on this slide, if we actually add up the entire stretch here, and this is a little bit over, 20 plus years, the diversified portfolio actually ends up ahead here, and does so with a heck of a lot less risk along the way, even though we don't really outline the risk here other than some of the big drawdown periods. But for us, this is a great reminder why we asset allocate, why we diversify, why we spread your investment eggs across a variety of investment baskets. It's all to get to what we call on this page winning more by losing less. Sounds a little bit like a riddle. Winning more by losing less. Just get a chunk of the upside of what the good market brings, but limit losses in the downturn. That's how you build wealth over time. It's just tough to see emotionally as you go through it, because some of these periods can be super frightening, right? Think of the first quarter of 2022, right? During the pandemic, all the challenges you had, our portfolios were rebalancing back to riskier assets in March of 2022. The market rallied following that. That was very difficult to do, given the uncertainty, given all the fear that was out there, given the fact the market was down, right, in bear market territory at that point. So for us, again, a good reminder why we build portfolios the way we do, all to get to this winning more by losing less story that you see here on the page. So probably a good place to land the plane here. Just in summary, think of where we started. I think that backdrop of an overall market where you're going to have the Federal Reserve lower short-term interest rates maybe once or twice in the second half of the year. No recession, at least at this point, that we can see on the horizon, which is out into 2025 at this point. But that's a good backdrop for risky assets, and that's why we're leaning into both at this point in time. We think certainly larger companies over smaller. We think that tech still has some room to run there. Don't let your politics into your portfolio. And then I think it's a perfect time to sit down and look at some of the options within bonds and fixed income. We haven't seen as many gains there as we have on the stock side. Maybe not a bad time to start to look at putting money to work into some of those bonds and fixed income vehicles, because once you start seeing short-term interest rates start to come down, that's when those cash rates will start to come down. So probably not a bad time to really reevaluate and see where there might be some opportunities. So I'll stop there. I'll stop sharing. Love to hear what's on everybody's mind. Love to take any questions or comments on the election or even inflation. As you can probably tell, I'm a little bit of an inflation geek, so always like to go on my inflation soapbox.
Yeah, and again, so if anyone wants to use the chat feature, you're more than welcome to do that and have it go through. Feel free to unmute. There's also the little hand raise icon. You can always raise your hand; it'll show up, and we can call on you to make sure everyone doesn't ask at once. And Mark, thank you so much. I thought what was the most interesting out of this was the first time I saw this was if you looked at what sectors did well under what presidents, they're all the exact opposite of what I would have guessed. So like under Trump, Trump, everyone remembers him jumping up and down saying, drill, 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 right? We're going to have American energy independence. and energy was the worst. It was the worst performing sector. And small caps underperforming. You would think especially in a Trump kind of, we'll call it a trade war, right? Where he's adding all these tariffs and then Biden has kept them. You'd think that would be great for small caps because as big companies brought their supply chains back, that might be able to boost small caps, which hasn't happened either. And then under Biden, what has been the best performing sector? I'm going to shut down all of the drilling and we're not going to do this on federal lands and we're going all, renewal. Energy is the number one producing. So yeah, a lot of the conversations we have around this time, every election cycle are around stuff like that, right? Which is, okay, Jason, what do we want to invest in based on, the policies of this president? And I think you could almost go, I could think of at least 10 off the top of my head. Those were just 3 that I thought would do well in a certain presidency, but I don't know if it's Congress not acting fast enough or the companies did not do it, but it doesn't seem to happen. So I think the message of keep your politics out of your investing it's just something people seem to have so much trouble with, but I love the message because it makes so much sense. And the numbers prove it out no matter, as I get older, it proves it out more and more. Right. And I'm always surprised.
No, absolutely. And one thing on the energy, think about Trump, drill brings more energy potentially eventually, takes a lot of years to actually hit the marketplace, but it means more supply. So it actually drives the price of oil down, which is exactly what happened in some of those years. So it tended to keep, help keep inflation low, but it wasn't great for the oil companies because the price of oil can help their overall bottom line, which is what we've seen here lately, right? Oil's drifted a little bit higher. And that certainly is one reason. And some of that's just, again, larger cycles at play here, right? That just play out over time. And the shorter term politics just get in the way a little bit. But I agree. You could probably stare at that chart and pull out a whole bunch of different nuggets. Like, energy was the best performer under Bush and Biden, right? Who would expect those kind of things?
All right, so I don't know if you can check these chats or not, but we've got I'll just read this out loud. At what point does the ballooning national debt tie the hands of the Fed between being able to sell treasuries, control inflation, and stimulate the economy? Very good question.
Yeah, great question. And it's great because I'm hearing this in all the calls I do across the country. It doesn't matter what part of the country. The debt's coming up more and more. It doesn't seem to come up in the political debate in any meaningful, substantial way on either side of the aisle, unfortunately. But people are worried about it, and they should be worried about it because we are going to run close to a $2 trillion deficit this year, which is unsustainable. Certainly at 34, almost $35 trillion now in the debt. That's getting to a point where we've got to start to address it and deal with it. Again, both sides of the aisle seem to want to kick the can down the road on it, where they don't want to deal with it because it's tough choices, right? It's figuring out how to collect more tax revenue and it's cutting spending. And they never seem to like to, especially on the cutting spending side, they never seem to like to do that. So it's a challenge, but we're going to have to deal with it because the question's spot on. It puts a lot of pressure on inflation. I think we've seen that here recently. The government spending is not the only reason, but it's a contributing reason to why we saw such high inflation is all the money they put to work during COVID. And certainly it puts pressure on interest rates. Just means it's going to cost more to finance anything, buy a new house, right? All those things that we know get impacted by interest rates. So I think we've seen a dose of it already, but we really need to hopefully elevate this conversation where it's a bigger part of the political conversation. It's kind of shocking to me that neither party has tried to grab onto it because, again, I'm hearing it consistently across the country. But they just don't seem to jump on it in a big way here.
And Mark, I think what Gordon is asking, is there some number, right? Is it a percentage of GDP? Is it a number like where does the debt start to really impact things like, I think he said specifically Fed being able to sell treasuries, control inflation, and stimulate the economy?
Yeah, I think it's no magic number, of course, right? I mean, you'd always say it's a percentage of the overall economy. And I think that's been the only saving grace that we've had is we've been able to grow better than other developed countries like Europe, Japan, right? That we just have much more robust economic growth than they do. So our debt picture looks a little bit better, but again, we're starting to squeeze the what would seem like the normal limits of 120% of GDP, right, is what you're talking about with the overall debt and deficit challenges at this point. So it's hard to say exactly when the point of no return would be, but right, it's just not, none of us would run our household financials this way, right, where we'd spend so much more than we're taking in that we're able to. It's just not a sustainable path. So it's certainly something that is going to eventually eat into economic growth at the end of the day, right? Because you're just going to have to rein in spending or, again, increase tax revenues. Both tend to be a drag on economic growth, which obviously that's why politicians love to kick the can. They don't want to be responsible for that slower economic growth. So.
And Gordon, I'd like to add, I think we're kind of there. I mean, I think if you, and again, Mark, I'm much smarter than me at stuff like this, but I think if you look at where interest rates are today in the 10-year Treasury, and you were to say, well, I wonder what these interest rates would be if we had, let's say, half the debt that we have now, they'd be lower, right? So I think the answer is we're there, that the amount of debt that we have makes the auctions, right, when the government is selling the bonds to either refinance or fund operations, that those interest rates are already higher. And then at that point, they're going to be higher, and if potentially then higher for longer. And even if the Fed lowers rates, they only lower the short end of the curve, right? The 1-day rates, but the 10-year Treasury doesn't move at all. And that is going to severely limit growth. And I think that we're probably close to there. I think we're there a little bit already. And I think we're getting more into that every day, where it's going to be impossible to lower interest rates because no one's going to want to buy the debt. Luckily, I'm sorry, Mark. Luckily, and I say this with all due respect to both sexes here. Luckily, we're like the least ugly guy at the bar, right? Meaning, yeah, we've got a lot of debt, but we also have way more economic growth, than like Mark was saying, than all of Europe, right? No one's even close. Way more than Japan. Japan has more debt than we do, as far as like a percentage of GDP, and their economy hasn't imploded yet, but they've had a lot of challenges. So luckily, everyone else is doing so bad that it allows us to continue this. If everyone else shapes up and their economies are growing, and they're doing really well economically, it'll compound the problem even more.
Yeah, and I think that you bring up a great point. It is probably affecting us now. Just think about, we talk about the dynamics. Think about the contrast between the bond market and the stock market the last couple of years. The bond market, you have more supply, right? Because we're borrowing at extensive levels, and you have less buyers. So more supply, less buyers is not a great combination, right? Because China's buying less, Japan's buying less debt, even our Federal Reserve is buying less of our debt. So we have fewer buyers, which just puts pressure on interest rates. And I think that's why you've seen rates be so volatile here. Look at the stock market. Yeah. So look, it's just pressure, right? Just pressure. Whenever the fundamentals don't line up, rates go higher, right? Where the other side, look at our stock market, where you have fewer companies that are going public and IPOing. You have a ton of buybacks. So you have shrinking supply of U.S. stocks, yet the buyers are still the same, if not more, than what we had a handful of years ago. So you have just this technical environment where, boy, it looks really good for stocks, and boy, it looks really bad for bonds in kind of the bigger picture. And I think that's been the story here the last couple of years, why stocks have done so well, and bonds, whenever, right, inflation or the economy looks like it's too hot, the rates go up. They just fundamentally just have only one direction to go in that environment. So, so builds on your point, I think is spot on.
Good. Well, is there anyone else either want to raise their hand or just unmute and turn their camera on or chat in? Feel free in the next couple seconds, and if not, we'll wrap it up and let everyone enjoy this beautiful evening.
I couldn't beg for any inflation questions there, huh? I thought we'd drag out a couple inflation.
Sorry, Mark. I'll call you after. We can talk. We'll talk.
Yeah, exactly. Fulfill my inflation soapbox.
That's right. All right, great. Well, thank you so much, everyone. I really appreciate it. If anyone has any feedback on this, again, I've never not been the main speaker ever in 25 years of doing this. So this is very new to me. So if anyone has any, thank you, Sharon. So if anyone has any feedback for, you know, whether we did it right or we did it wrong, because again, almost everyone on here has been on previous ones and has seen the difference. So anything that we can do to improve, we're always open to that. And again, thank you so much. We wouldn't be in position to be able to offer these like this without all of you. So thanks again, Dylan. If you want to put up the disclaimer real fast, we can do that. And then I will end it after that. So thanks again, everyone. Mark,
Thanks,
have a great
everybody.
one.
Thanks, Jason.
Yep.
Take care.
Yep. See ya.